Good morning. Good morning. And thanks for coming. Alma loves it. I love it. Charlie loves it. We're glad to have you here. We're going to make this preliminary before the questions very short because we want to get in at least 60 questions, half divided by the audience outside this arena and half from you. So I would just like to get right to the directors and the earnings that have been put up on our web page this morning. But we'll cover those very fast, and then we'll get to the questions. Now, when I woke up this morning, I realized that we had a competitive broadcast going out somewhere in the UK, and they were celebrating King Charles, and we've got our own King Charles here today. And next to him we have Greg Abel, who's in charge of all the operations except for insurance. Next. And next to Greg, we have a man I ran into in 1986 and has made us look good ever since. We have the man in charge of insurance, Ajit Jain. Ajit. And now we have our directors here in front, and if they would just stand briefly, and then I'll go on to the next one. And they're all here today. First of all, doing alphabetically, there's Howard Buffett. There's Susie Buffett. There's Steve Burke. Ken Chenault. Chris Davis. Sue Decker. Charlotte Guyman. Tom Murphy Jr., Ron Olson, Wally Weiss, and Meryl Whitmer. That's as good as you can get. And there's one other person I would like to mention before we get on to the earnings that were put on in the press release this morning. And that's, well, let's see who we have here. We've got, this is hard to believe. Can you imagine a name? Melissa Shapiro Shapiro. And she was Melissa Shapiro till she married another Shapiro. And she put this whole thing together with no help from me, no help from Charlie, and a lot of help from the people in the other room. Melissa? Yeah, it's very easy. If you can remember her second name, you can remember her third name. So Melissa Shapiro Shapiro. And with that, I would like to next move on to the earnings and a couple small slides that explain what we're all about, and then we're going to get to the Q&A. And the slide is up behind me. Yeah, there it is. We reported in the first quarter operating earnings a little over $8 billion. And when we talk about operating earnings, we're basically referring to the earnings of Berkshire Hathaway as required under GAAP, excluding, however, capital gains, both realized and unrealized. There's a few other very minor items, but basically, we expect to make capital gains over time. Why would we own the stocks otherwise? It doesn't always work out, but overall, it works out pretty well over time. But in any day, any quarter, any year, even occasionally over a 5-year period, the stock prices move around capriciously. Now, we own a lot of other businesses. We consider those stocks businesses. We own a lot of other businesses where they get consolidated, and they don't move around in value. Now, if we had a little bit of Burlington stock outstanding, if we had a little bit of the energy stock trading, those stocks would move around a lot. But the businesses are what count. So the operating earnings, as you'll see, in the first quarter came in at about $8 billion. And I would say that in the general economy, the feedback we get is that I would say perhaps a majority of our businesses will actually report lower earnings this year than last year. In various degrees in the last 6 months or so, at various times, the businesses have left the incredible period, which is about as extraordinary as I've seen in business since World War II, where the government poured out a lot of money to people who couldn't get goods. It was more extreme in World War II, but this was extreme this time. And it was just a question of getting goods to deliver, and people bought, and they didn't wait for sales. And if you couldn't sell them one thing, they would put another thing in their backlog. It was an extraordinary period, and that period has ended. It hasn't ended with, as you know, it isn't that employment's fallen off a cliff or anything in the least, but it is a different climate than it was 6 months ago, and a number of our managers were surprised. Some of them had too much inventory on order, and then all of a sudden it got delivered, and people weren't in the same frame of mind as earlier. And now we'll start having sales at places where we didn't need to have sales before. But despite the fact that this year, I think in general, will be slower than last year, we actually are situated so that I would expect, and believe me, when I say expect, it's nothing is sure. Nothing's sure tomorrow, nothing's sure next year, and nothing is ever sure, either in markets or in business forecasts or anything else. And we don't pay much attention to markets or forecasts unless the markets happen to offer something interesting to do. But nevertheless, we are positioned in two respects, as you'll see from this first report. Our investment income is going to be a lot larger this year than last year, and that's built in. I mean, we had, as you'll see in a minute, we've had $125 billion or so in very short-term investments, and believe it or not that long ago, we were getting 4 basis points, which is next to nothing, on that $125 billion, which means we were getting $50 million a year. And now the same money, just day before yesterday, we actually bought, because of some funny twist in the market because of doubts about the deficit ceiling, or the debt ceiling, we bought $3 billion of bills at a 5.90. That's 5.9. It's a 5.92 bond equivalent yield. So we will have what produced us not that long ago on a 12-month basis was producing $50 million a year, producing something in the area of $5 billion a year. So we're in a position where the investment income is essentially, well, it is certain to increase quite a bit. And insurance underwriting is not it does not correlate with business activity. It depends on things like hurricanes and earthquakes and other events. So on a prospective basis, on a probability basis, we're likely to have a better year this year in insurance underwriting than we had last year. It just isn't affected by what you might call the business cycle or what applies to generally in industry, retailing, you name it. So I would expect in one massive earthquake or one hurricane that came in at just the wrong place can affect that prediction. But on a probabilistic basis, our insurance looks better this year. So if you get two of the elements there of our main elements of earnings that look like they will swing in our direction, I would expect, but I can't promise, that our operating earnings will be greater than last year. And if we'll move to the second slide, I give you those operating earnings figures just to give you an overview of what has happened since the pandemic started and off the year before as a base. And we retain all our earnings, as you know. So if we're retaining 30 or 35 billion or whatever it may be a year, you should expect more operating earnings over time. I mean, this number should be significantly higher 5 or 10 or 15 years from now because we have the advantage of retaining earnings, and that's what got us to these figures because they were essentially nothing when we started, and they got there by retaining earnings, and we'll keep retaining earnings. So it's no great triumph if these numbers move up, and what we hope is that they move up at a reasonable rate. Historically, they moved up at an unreasonable rate sometimes, but we were working with much smaller sums then, and that can't be repeated with our present capital base. Because I note there, I believe it's on this slide, let's take a look. Now that'll be, let's see, it's on the, well, on the next page, let's move to the next slide. We show that we had, on March 31st, now 504 billion of GAAP net worth. Now, what might surprise you is that there's no other company in the United States, no other company that has a number that is that large. Now, that isn't because we've got the most valuable company in the United States. Other companies have used their money to repurchase shares. They could have accumulated 504 billion in GAAP. But basically, we have more under GAAP accounting now than any other company in the U.S. And of course, if you measure return on equity, that becomes a very big number to increase at a rapid rate, but we hope to do so. Not a rapid rate, a decent rate. And right below that, you see something called float. And float is money that is left in our hands, somewhat akin, but very importantly different than a bank deposit. But you have to pay interest to get a bank deposit. You have to pay more interest these days, and you have to run a bank and do a lot of things. And basically, this is money that represents unpaid losses at this time. You get paid in advance in insurance. So what shows up as a net liability on our balance sheet gives us funds to exercise with an amount of discretion that no other insurance company that I know of in the world enjoys, just because we have so much net worth. And our float now comes to 165 billion, and the man sitting on the far left is responsible for moving that number up from a pittance in 1986 to this incredible figure, which in most years, practically all years, hasn't cost us anything. So it's like having a bank with no employees, no interest, and no ability to withdraw the money in a hurry that we have working for us. And it's a very valuable asset that shows up as a liability. And Ajit is responsible for building up this treasure, which has been done by outcompeting insurance companies all over the world. And then now a number of our insurance companies in turn are run by talented managers who contributed one way or another. Start with Geico at the beginning of my career. And that float, if you think about it, just think of a balance sheet. You've got liabilities here, and you got assets over here. And the liability side finances the asset side. It's very simple. And stockholders' equity finances it, long-term debt finances it, and so on. But stockholders' equity is very expensive in a real sense. Long-term debt has been cheap for a while, but it can get expensive, and it can also become due eventually, and it may not be available. But float is another item that shows it's a liability, but hasn't cost us anything, and it can't disappear in a hurry, and it finances the asset side in the same way as stockholders' equity. And nobody else thinks of it much that way, but we've always thought of it that way, and it's built up over time. So I show at the bottom what's happened with cash and treasury bills through March 31st, and I will tell you that in the month of April, we probably added about $7 billion to that factor. Now, part of that is because we didn't buy as much stock, because that reduces cash and treasury bills. We bought about $400 million worth of stock in the month of April. That's a minus in terms of cash available. And we, however, sold net some stock, which produced maybe $4 billion. And of course, we had operating earnings, probably $2.5 billion or something in that area. And my guess is we probably increased our cash and treasury bills $6 and $7 billion in the month. And I just want to give you a feel for how the cash flows at Berkshire. And then if we move to the final, I think it's the final one, next to last one. No, I think it is the last one. Let's see, is the fourth? Yeah, we should have the one up there, Class A equivalent shares outstanding. And you'll notice that every year the number of our shares go down. So if we own more businesses and the businesses make more money, your share as shareholders, as owners of Berkshire, increases every year without you laying out any money. Now you're laying out the alternative, which you could receive in dividends, but the reason we've gotten to where we are is because we kept the money. We did pay a dividend in 1967, 10 cents a share. It was a terrible mistake. And I always tell people that I'd left for the men's room and the directors voted while I was gone, but that isn't true. I was there, I confess. But we reinvested, and that's produced the $500 billion plus of shareholders' equity and the $30 billion plus of operating earnings. And we'll continue to follow that policy because it makes a great deal of sense. And with that, I think we've taken care of the preliminaries. You can study the 10Q is on the web page, and if you have a week or two vacation, you could spend it reading the 10Q. But that is the essence of Berkshire, and with that I will start with Becky Quick, and we will alternate between Becky and the audience, and her questions have come in from all over the country, and I believe you identified the sender, and go to it, Becky.
Thanks, Warren. The first question comes in from Randy Jeffs in Irvine, California, and his question is, if Silicon Valley Bank's deposit had not been fully covered, what do you think the economic consequences would have been to the nation?
Well, I would just simply say it would have been catastrophic. And that's why they were covered. And even though the FDIC limit is $250,000, that's the way the statute reads, but that is not the way the U.S. is going to behave any more than they're going to let the debt ceiling cause the world to go into turmoil. And I can't imagine anybody in the administration, in the Congress, in the Federal Reserve, whatever it may have been, FDIC, I can't imagine anybody saying, I'd like to be the one on television tomorrow and explain to the American public why we're keeping only $250,000 insured, and we're going to start a run on every bank in the country and disrupt the world financial system. So I think it was inevitable. Charlie, do you have any?
No, I have nothing to add.
Okay, well, incidentally, I should mention this now. Ajit and Greg will be here in the morning session, which ends at noon. And so if you've got questions to direct to them, the time to do it is in the first half of the show. And then after lunch, it'll just Charlie and I will be back. Okay. Area 1.
Hi, Nirav Patel, Haverhill, Massachusetts. Mr. Buffett, Mr. Munger, it seems like you found the sweet spot between being too conservative and too aggressive as investors. Do you ever make bad investment decisions because of your emotions, and what do you do to try to keep that from happening?
Well, we make bad investment decisions plenty of times. I make more than Charlie because I like to think it's because I make more decisions, but probably my batting average is worse. But I can't recall any time in the history of Berkshire that we made an emotional decision. That I know the movie had Jamie Lee in there, but that was for laughs. I mean, Jamie Lee, she's good, but she's not good enough to get me or Charlie to make an emotional decision. Charlie, I'm sure you have something to add on that.
Well, it's a different movie than is shown at most corporate meetings.
Yeah. But have we ever made an emotional decision?
No.
Oh, yeah. That's in business we're talking about. Yeah. No, you don't want to be a no emotion person in all of your life, but you definitely want to be a no emotion person in making an investment or business decision. You can argue that we probably, I would say that we made an emotional decision perhaps, and when a manager has been with us for some period, and we've ignored the fact that perhaps they weren't quite what they were earlier. But our businesses are so good that they've run better sometimes. I've talked about Wesco, for example, the wonderful Louisville incentive, and it ran on automatic pilot for a while, but I don't think we suffered by it. But you can argue that if Charlie and I hadn't liked Louis as much as we did, we might have spotted it a little bit early, but I don't think it made any difference in the results. Would you agree with that, Charlie?
Yeah, I agree totally with it. And I'm glad we behaved the way we did at Wesco. By the way, we bought the thing for a few tens of millions and it became worth $2 or $3 billion.
Yeah, that wasn't common in the savings and loan business, as you may have noticed. They really went crazy in that industry, and we had a wonderful guy in Louis. And
we didn't go crazy.
Yeah, we didn't go crazy. But, okay, Becky?
This question comes from Ben Knoll in Minneapolis. He says he's a Berkshire shareholder of 3 decades, and he's attended many Berkshire meetings. He's here again this year. And this is addressed to Ajit and Greg. He says, last year I asked you about how Geico and BNSF appeared to lose ground to their leading competitors, Geico on telematics and BNSF on precision scheduled railroading. Ajit, you responded by saying how you expected Geico to make progress in a year or 2. Greg, you spoke about your pride in BNSF, but you didn't directly address the threat of precision scheduled railroading. Will each of you please provide perspective on these competitive challenges and our company's strategies to address them?
In terms of Geico and telematics, let me make the observation that Geico has certainly taken the bull by the horns and has made rapid strides in terms of trying to bridge the gap in terms of telematics and its competitors. They have now reached a point where on all new business, close to 90% has a telematics input to the pricing decision. Unfortunately, less than half of that is being taken up by the policyholders. The other point I want to make is even though we have made improvements in terms of bridging the gap on telematics, we still haven't started to realize the true benefit. And the real culprit or the bottleneck is technology. Geico's technology needs a lot more work than I thought it did. It has more than 500, actually more than 600 legacy systems that don't really talk to each other. And we're trying to compress them to no more than 15, 16 systems that all talk to each other. That's a monumental challenge, and because of that, even though we have made improvements in telematics, we still have a long way to go because of technology. Because of that, and because of the whole issue more broadly in terms of matching rate to risk, Geico is still work in progress. I don't know if any of you had a chance to look at the first quarter results, but Geico has had a very good first quarter, coming in at a combined ratio of 93 and change, which means a margin of 6 and change. Even though that's very good, it's not something we can take to the bank because there are 2 unusual items that contributed to it. Firstly, we've had what is called prior year reserve releases. We've reduced reserves for the previous years, and that contributed to it. And secondly, every year, the first quarter tends to be a seasonally good quarter for auto insurance writers. So if you adjust for those 2 factors, my guess is the end of the year, Geico will end up with a combined ratio just south of 100, as opposed to the target they're shooting for is 96. I hope they reach the target of 96 by the end of next year. But instead of getting too excited about it, I think it's important to realize that even if we reach 96, it will come at the expense of having lost policyholders. There is a trade-off between profitability and growth, and clearly we're going to emphasize profitability and not growth, and that will come at the expense of policyholders. So it will not be until 2 years from now that we'll be back on track, fighting the battles on both the profitability and the growth front.
Greg?
Yep. Moving to BNSF, I'll start again by expressing great pride in the BNSF team. We have an exceptional group led by Katie and her managers that show up every day to do great work on the railroad. At the same time, they would be the first to acknowledge there's more to be done there. The specific reference to precision scheduled railroading. The other large railroad, Class A railroads in the U.S. follow that, and including the 2 in Canada. We're well aware of what they're doing and obviously pay close attention to their operating metrics. And our team strives every day to be more efficient, obviously. I would say we balance it with the needs of our customers. If I look back to pre-2022, so we look at the 3-year period of 2019, 2020, 2021, the BNSF team made significant progress on their efficiencies and delivering overall value back to the shareholders and to their customers, and at the same time maintaining a very safe railroad for our employees. So we're making excellent progress. That didn't stop last year. They made great progress again. The reality in 2022 is we did go through a period of time where we had to call it reset the railroad. We came out of the pandemic. There were the supply challenges. We had certain other labor issues and other things going on at the port. And the reality is our team prioritized getting the railroad back in place for the long term, not a short-term focus on hitting certain operating metrics in 2022. We're well aware of where we were relative to those metrics, but the real focus was to get the railroad reset in a safe manner such that we could deliver long-term value and long-term service to our customers. And that's really what we'll continue to see with that team. There'll be continual progress. There'll be years where it's not as quickly or even we go backwards, but over the long term, we'll see exceptional results from that team and couldn't be more proud that we have that asset. Thank you.
I would just, well, both of them deserve applause. I would like to add one thing. At Geico, Todd Combs was Ajit's choice, my choice. Go back to Geico to work on the problem of matching rate to risk, which is what insurance is all about. And he arrived with exquisite timing right before the pandemic broke out, and all kinds of things changed. But Todd is doing a wonderful job at Geico, and he works closely with Ajit because he still has a home in Omaha. He comes back here, and we get together on the weekend sometimes too. So that's been a remarkable accomplishment under difficult circumstances, and he's not all the way home, but he's made a very, very big change in multiple ways at Geico. And then one other thing I would like to mention, there have been a lot of public companies created in the last decade or thereabouts in insurance. And there's none of them that we would like to own. And they always started out in their prospectus saying this is a tech company, not an insurance company. Of course they're in a tech company. Everybody's, whether they're in insurance or a lot of other places, are using the facility, but you still have to properly match rate to risk. And they invariably have reported the huge losses. They've eaten up capital. But there's been one company that nobody has generally heard of. There's only been one that I know of. Company started in the last 10 years that has been an overwhelming success, and that's a company that Ajit and 4 people who joined with him set to develop a new business. It's called Berkshire Hathaway Specialty. It now has, what's the float, Ajit?
Coming up to $12 billion.
Yeah. We've built more float than probably all these companies combined. It's cost us essentially nothing in terms of an underwriting loss. The 4 people have turned in, 1,500 around the world. We took on the whole industry, and we brought some unique talent in the 4 people that came and now have, like I said, 1,500 or so worldwide. And we brought capital, and we brought capabilities that really only Berkshire could supply. So it was the combination of of brains and talent and energy and money. And no one has really successfully entered this space. Plenty of people in the space who didn't like us coming, and we did it without it costing us a dime of entry. And it's been unmatched by any of the public companies that went public. And people have seen us do it, but they can't duplicate it. And that's what Ajit has created. And Peter Eastwood has led this group, Berkshire Hathaway especially. And it's just remarkable. So anyway, with that, let's go on. Yeah, well, give him a hand for that. Okay, let's go to section 2.